Hello, this is Doug Gerlach from iClub Central. Welcome to our Lunchtime Stock Club. Today is Monday, September 12th, 2016. Thank you for joining us today. If this is your first time, our Lunchtime Stock Club is our monthly gathering where we talk about stock ideas, the state of the market, interesting books and other media that you might be interested in, and usually we'll have a stock tip or two, at least an idea for you to study for your or your club portfolio. Before we begin, let's get started with our regular housekeeping. A reminder that GoToWebinar is the host of our webinars, and they provide technical support so if you're having any sorts of problems at all, please call them right away or visit their website. I am speaking, so you should be able to hear me now. If the sound or graphics drops out along the way or becomes choppy for extended periods, it may be your computer. It may be programs that are running in the background. We recommend that you turn those off for the duration of the webinar. It could be that you're connected using Wi-Fi, which generates a slower connection from your computer to the internet. And if you can help it, a wired connection will always be faster. And the GoToWebinar invitation includes the details for how to dial the audio portion on your phone, and that can free up your computer to process the video component of our webinar. Now, you don't need a microphone. If you have questions, please go ahead and use that questions box at any time, and I'll do my best to answer your questions during the presentation as well as at the end. I do have a handout for today's presentation that you can download. It's a PDF. It's in the Handouts tab in the GoToWebinar application. So just look for that PDF icon. Click on that. It should open in your browser or on your computer, or it should be saved to your computer. You can print it out very quickly, or you can save it for future reference, but it is there and will be provided when we archive this broadcast as well. Now, speaking of archives, all of our webinars are listed on the IClubcom website. Click on the Learning tab. There we have our complete schedule of upcoming webinars, as well as links to our archived webinars for viewing on demand and links to the handouts that are included in the archived webinar video. So you'll be able to find those there. We have almost a decade's worth of webinars now that have been archived that cover all sorts of topics. On the Toolkit 6 program, we have webinars that deal with just about every component of the program. For investment clubs, we have webinars that tackle just about every question that clubs and club members have about running clubs and club accounting. And then our lunchtime learning webinars, our lunchtime stock club webinars are available as well, so you can review the recent ones. Maybe pick up some ideas for your portfolio if you do that. You can also find us on Facebook. Just search for iClub Central, all one word, and you'll be able to like us there and get occasional updates. And special offers every once in a while. We have some deals and steals on programs and products and newsletters, so you can keep up to date with everything that's going on there on Facebook. Look for iClub Central and find us there. So let's tackle where we are right now in the stock market first, because it has been an interesting year, a variable year, a year with lots of ups and downs and surprises. And most recently, we see a little bit of a pullback in the S&P 500 as it has reached an all-time high level. And then last Friday, concerns about energy again, oil prices, and concerns about where interest rates are going have caused a little bit of a pullback in the market. This morning, it recovered a little bit. This is our year-to-date graph of the market sectors that I like to track. The blue line is the S&P 500. The green line is the Russell 2000 small cap index, and the magenta line is the Morgan Stanley Europe Australasia Far East index, the index of the developed world largest companies, publicly traded companies. So you can see there that the small caps have rebounded from a 20% decline, a bear market actually, that it reached in February, and now is up 7.4% year to date. And as of last week, had been up more than 10% year to date. This is one of the reasons why we like to see small companies in our portfolios. The S&P 500 had been up 6 or 7% and is now down 4.5% or up 4.5% year to date. And the EFA index is down 0.6%. Well, obviously, lots going on with the European economy, with Brexit and the UK. And just a whole lot of uncertainty there as they grapple with the economic cycle in the major European countries. So this puts us in an interesting position. I mean, this is the year is almost 3/4 of the way done, and we're still seeing just moderate performance from the S&P 500, which is pretty much in line with, I think, what we expected as we were heading into the year. Just to peg everything, the all-time high was reached in mid-August for the S&P 500. So it's pulled back a little since then, which is probably a good thing. The Russell 2000, however, is still down from the high reached in June of 2015. But up 7.4% year to date. And the EFA is still well off the high that it reached in mid-2014. So it's been a long 2 years for the international market. But if you are a follower of one of the strategies that I helped to propagate back in the early 2000s, the armchair millionaire approach, these are the 3 index funds that I track in my personal 401k. As one of these sectors reaches, one of these segments reaches all-time highs, then I'll reallocate a little bit my future contributions so that I'm buying more of the segment that's down. So right now I'm a little, new money is coming in and going into the EFA index at a higher rate, figuring that over time I'm going to get the advantage of a little bit of a boost when the EFA does turn around, when the US indexes slow down a little bit their upward trajectory. But that's where we stand right now. We're still waiting, of course, for the third quarter to end at the end of September. And then so in mid to late October, we'll start getting a sense of the performance of the large companies with their third quarter earnings. And again, most analysts, I think, are still looking at a little bit of a recovery from the third quarter, coming in the third quarter from the second quarter, the first quarter, where we saw a lot of large cap weakness in corporate profits, and hopefully we'll be able to head into the year-end season with some strength and momentum. But when we look at the valuation of the S&P 500, it is hard to see on this graph, but actually that PE of 24.7 is down from where we were in mid-August. When we had our webinar in mid-August, the S&P 500 PE was 25.24. So this is a little bit of a decline, and we haven't seen that at least on our monthly webinars. We haven't seen that sort of decline from a month-to-month basis since back in May or June of 2015. And then we saw a little bit of a pullback in October of last year. The PE ratio of the S&P 500 was just 20.3. So you can see that we have gone up quite a bit since that time. If we take a look again at where we were earlier, we saw the S&P 500 PE ratio reach a low of in the 14 range on a trailing basis. So we've seen quite a bit of acceleration and growth in the S&P 500 PE ratio, but a little bit of a recent pullback, which is I think it's good to see. Obviously, when you look at this graph, the current PE ratio is high relative to much of the history of the market, relative to the period from 1990 onward. You just see the increasing volatility on a trailing 12-month basis. You see PE ratios all over the map. During the financial crisis and financial meltdown of 2007 and 2008, you can see PE ratios going through the roof. as a lot of companies were posting negative results. And I've capped this at about 50, but the actual PE goes up to more than 65, the PE on a trailing 12-month basis. As investors were holding on to stocks, certainly the price is corrected, but earnings were so far diminished that the PE ratio climbed exceedingly high. And I would consider that certainly a bit of an outlier. And again, in 2000, we see another, in the early 2000s, we saw another peak. So it's really hard to gain a sense of if there is a new normal to PE ratios, but we do see a little bit of pullback, which I think is generally a positive thing. I don't like it when the market PE gets so frothy and in such high territory. I would love to see it come back, drift back a little bit closer to 20, and I think if corporate earnings do pick up, that's what we're likely to see. Unfortunately, corporate earnings continue to decline. The S&P 500 earnings on a trailing 4-quarter basis as of today were $87.35. That's down from August, $87.49, down from July, $87.89, down from January 2016, where they were at 94, down from earlier. You can see where earnings were above $100 for the S&P 500 at their peak a couple of years ago, and now they've pulled back to $87. This is the dilemma of the current market, where we see valuations high, earnings declining for large caps, and investors still sticking with the market primarily, I think, because where else are you going to go? You can't go to bonds, you can't go to the bank, you can't get a yield that approximates the return that you can get just even by holding blue chip stocks for the dividend, no less the capital appreciation. So where there is demand, there is support, and I think that's what we continue to see in the market. Even as we see that weakness in S&P 500, I think that suggests that we use caution when investing in larger companies. Certainly our approach, where we focus on growth, demands profitability and does not like companies that are posting declines on a regular basis or seeing significant slowdowns in their growth. But just remember to focus on quality companies, and when we can buy those great companies at reasonable valuations, we're going to expect to see market performance or fundamental company performance exceed market performance over the long term. And of course, that long term is what is most critical for our portfolio performance. I noticed in the handout I have the old My Stock Prospector product spotlight. We're going to skip over that and go right into some words of wisdom. I like to look at the history of the market, consider what the most brilliant minds have had to say about the market and what we can glean from that to utilize in our own approach to investing. And this month, I found a quote in my reading from Paul Samuelson, who won the Nobel Prize in economics and is probably one of the best-known contemporary economists. He's the author of the best-selling economics textbook of all time, Economics: An Introductory Analysis, that was first published in 1948. It has in nearly 20 editions and has sold nearly 4 million copies, and it's been translated to 40 languages. So he is an influential economist, to be sure. And he wrote this in a column in Newsweek: to prove that Wall Street is an early omen of movements still to come in GNP, the gross national product, commentators quote economic studies alleging that market downturns predicted 4 out of the last 5 recessions. That is an understatement. Wall Street indexes predicted 9 out of the last 5 recessions, and its mistakes were beauties. This is a favorite quote, often kind of summarized, but Samuelson's take on the market and the connection to the economy is that essentially we're not going to be able to predict recessions by looking at what individual investors are doing or what investors in general are doing in the market indexes. Recessions happen when a whole lot of factors come together and cause our gross domestic product to slow down, to decline for consecutive quarters, and the factors that go into whether or not a recession is going to happen are so complicated that no one has really come up with a model for how to predict them successfully. In the similar way, no one has come up with a model that will predict how the stock market will perform in advance of its actual performance. So I like this, I like the quote here, and it's a reminder for us that having the right time frame as investors is essential, and to acknowledge that recessions and corrections are inevitable. And if your approach depends on knowing when we're going to have a recession or a correction or a bear market, I really think you're engaged in a losing battle. There's just no predictability to the market that we can figure out or that we have figured out right now. So we, as always, don't look at trading strategies as a formula for success, but like to stick with the tried and true fundamental approach that takes advantage of the long-term trends of the market and of the economic output of the United States and try to benefit from that. And we think that those are the most appropriate solutions for those investors looking to outperform the market on a consistent basis. Well, I've obviously been thinking about the economy and about the predictability of the markets, and that's in large part because of a book that I recently read called The Physics of Wall Street by James Owen Weatherall, subtitled A Brief History of Predicting the Unpredictable. So this is a book that is part history of some of the key thinking in developing models for the performance of the market over time, part a plea for continued research in this area, part a discussion of what works and what doesn't work. The author is a physicist. He's got a PhD in physics, but he's also a professor of logic and philosophy. And that's really interesting. His primary self-described career career title is philosopher, but he's also obviously a smart guy with a doctorate in physics and an understanding of mathematics, and he's a member of UC Irvine's Institute for Mathematical Behavioral Science as well. So this is kind of an interesting melding of disciplines to my view. And the book is very well written. It's very enjoyable. It's never so exceedingly scientific or technical that you can't make heads or tails on it. But a lot of the book has to do with quantitative analysis, which is a field that has sprung up in the last 20 to 30 years. We have technical analysis, we have fundamental analysis, and we have quantitative analysis where scientists and mathematicians and economists are trying to figure out if we can predict a stock or a market's performance by looking at strictly at the numbers, strictly at the science behind them all. As Weatherall points out in the book, physicists and mathematicians have moved into the finance sector, and they brought some radically new ideas. And the title itself, The Physics of Wall Street, seems to be such a contradiction and begs the question, what does physics have to do with Wall Street finance? Well, in terms of quantitative analysis, this is indeed what's been happening in the books, an attempt to understand quants and these models that they use to predict market behavior. And Weatherall starts the book by pointing out that the best performing investor in the world is not Warren Buffett, but a fund run by a physicist named Jim Simons. His Renaissance Technologies company has a medallion fund that was started in the 1980s. From 1988 to 1998, the fund earned a cumulative 2,478.6% return. So that's in a decade. That's the return through 1998. In 2007, the fund owned 73.7%, and in 2008, when the market melted down, they earned 80%. Interesting thing about the Renaissance Technologies business is that a third of its employees have PhDs, but not in finance, in physics, mathematics, and statistics. So is there anything we can learn from this quantitative approach or from the science-based approach to economics and the markets? Well, as Warren Buffett warned after the 2008 economic meltdown, beware of geeks bearing formulas. And certainly a lot of the work of the quants went into the 2008 financial meltdown, but primarily in the application that these quantitative models were developed, and the banks, rather than just stick with them, were so confident that they ended up creating lots of leveraged-based variance, and all of that leverage, when the models failed, were the catalyst for the financial meltdown. Certainly in 2007, the Black Swan by Nassim Taleb argues that predictions are impossible, that the randomness is so integrated into the markets and into the world, into our daily lives, that trying to find order and patterns is ingrained in us. It's a survival instinct. It's at a very subconscious level. We attempt to find connections and make connections between events that have nothing to do with each other. We mistake correlation for causation, and so Taleb argues that we should be forgetting about this altogether, and we'd be much better off if we accept that everything is random, more or less. Weatherall counters that argument by saying that just because the scientists haven't found a model yet that works doesn't mean they won't. And that each step of the way, there are breakthroughs that have been made over the past 50, 60 years in mathematics and in science and in physics that have been used to help advance the science, if you will, of Wall Street. And so that's kind of an interesting approach. A criticism, the reviewer for the New York Times said that, well, if the only tool you have is a hammer, then every problem looks like a nail. So essentially saying, yeah, if you're a physicist and that's all you know, then when you look at the problems of predicting Wall Street performance or predicting the direction of the economy, then physics is the tool that you think might work best to do that. But there have been many key discoveries from science, and this is, I thought this was a very entertaining and informative part of the book. For sure. We've all heard of Mandelbrot's fractals, fractal geometry, and the science beyond that often portrayed as these beautiful recurring patterns. And it's interesting that Mandelbrot also discovered that normal and log normal distributions cannot capture the full wildness of financial markets. So he actually was applying the science of fractal geometry and trying to find order in the markets, and found that the usual distributions that were being calculated just didn't work for financial markets. You've probably heard of the Black Scholes model of valuing stock options. Well, these, when Fisher Black and Myron Scholes first created this model, they were coming at it from a perspective outside the usual realm of economics, and so their publication, their paper was rejected by most of the leading economic journals. Scholes would go on to win the Nobel Prize, and the Black-Scholes model of valuing options became a standard way for investors to calculate how much a particular option was worth. Another interesting scientist, Edward Thorpe, he was the inventor of the modern quantitative hedge fund, but he was originally a mathematician, and he came up with the methods of counting cards and tested it in Las Vegas casinos, and that forced Las Vegas to make changes in the game of blackjack. How many cards were in a deck of cards were in a shoe, for instance, and what the betting, how you could bet, etc. And he went on to try to devise a strategy for roulette based on where the ball was released on the roulette wheel, and then figuring that you could limit the potential outcomes as a result of knowing where the ball was released. If it was released at a particular number, because all roulette wheels are constructed the same way, figuring that, and they're usually balanced on a regular basis, but you could isolate the range of where the ball would most likely land if you had a fast enough computer processing power and to know from that point where to place your bet. So it's a very interesting approach and way of thinking about how science has impacted us already. Those discoveries that the physicists and mathematicians have been making in the market. So overall, is this a book that's going to help you learn how to be a better investor? Perhaps not. If you like reading about financial history, if you like reading about science particularly from a non-scientific perspective, I think this is a really enjoyable book. And again, from my perspective, the more I know and understand about how the markets and how the economy work and how key thinkers in the economics discipline and financial markets came to their conclusions, I feel like that helps me to solidify my thinking about the best way to invest in my portfolio. And as always, if the markets are unpredictable, if no one figures it out, if we don't have, never develop a faster enough supercomputer that can calculate every potential factor that goes into the economy and what causes it to slow and what causes it to increase its growth, then we have a solution, which is not focusing on the short-term direction, but focusing on the long-term direction, which has to date always been correct. The market continues to grow, the economy continues to grow as well. So looking forward to hearing what books you might be reading, especially those that have come out in the last year or two. So please feel free to give me feedback if you do read The Physics of Wall Street, to give me an idea of how you like it as well. So let's take a look at a company of interest. Today we're gonna go into the Investor Advisory Service and pull out a stock from its most recent edition, the September issue of the IAS. And one of the recommended stocks was the Cheesecake Factory. It was recommended in the September issue. This is obviously in the restaurant industry. The current price is about $50. It was closed below $50 on Friday. This morning it's about $50.26. It was $52 when the issue came out a couple of weeks ago. So it's pulled back a little, which makes it a little more attractive than it was at the time of publication. The current PE is 20. The current yield is 1.9%. It's been as high as 55, 58 in the last 52 weeks. The current buy up to price is about $56.50. That's based on a little tweaking. That's my buy up to price. I've done a little tweaking, looking at the projected high and low PE ratios and prices, but it's pretty close to what it was in the issue. Our analysts are looking at 12% earnings growth on 6% sales growth, so they're factoring in quite a bit of margin expansion and share buybacks with the excess cash the company has, but that will still get you to about a 14.5% return on an annualized basis over the next 5 years. Now, when we look at the graph here, you'll see that total revenues are about $2.1 billion. So this is what we would consider a mid-sized company, but it's pretty small relative to some of the mega restaurant chains. But in the casual dining atmosphere, it is definitely a leader. As someone pointed out to me, a subscriber pointed out to me, they like the impact that the television series, The Big Bang Theory, has on on Cheesecake Factory. The Big Bang Theory, one of the characters, two of the characters work as waitresses in the Cheesecake Factory, and the cast on the show, the friends commonly meet up there every couple of episodes and have a meal at the Cheesecake Factory. But as you can see, sales have been pretty consistent over the last decade. The company has been around for about 25 years. You also will notice what happens during a recession. So we see 2008, 2009, you see here earnings and more profits going down. But then when the recovery comes, they jumped right back up in 2010. They've been plugging along more or less since then at about a 12% rate, a little faster than 12% a year since 2010, but the growth rate on average over the decade that we show here is 12.6%. You probably are familiar with the Cheesecake Factory. They have about 189 locations across the United States. The average guest check is about $21, which is pretty significant, and that is puts it at a little bit of the higher range of the casual dining experience in the U.S. I think most people would agree that this is a little fancier than going to Applebee's or Chili's or some of the other casual dining chains. Takeout accounts for about 10% of sales, and some locations are actually experimenting with delivery options. And that's kind of an interesting. I was surprised at even 10% of sales being takeout, because I just don't think of the Cheesecake Factory as being a place where you run in and grab a meal to go, but a place where you run in with family, with friends, you sit down and you enjoy a nice, not unreasonably expensive dining experience. The overall strategy, according to our IS analysts, might be categorized as aggressive on defense and careful on offense. And just to look at how moderately the company grows and expands, I think people would be surprised when if they knew about the Cheesecake Factory, which I think most people do, but to know that they only have about under 200 restaurants across the whole country. I think people would be surprised at that. They seem to have a profile that's a little bit higher than that. But the company is debt-free. All their locations are leased, so they don't own any properties. Their plan is to add just about 8 locations in 2016. So you can see this is not an aggressively growing, aggressively expanding chain. They're taking their time about it. This would be about a 4% increase in their overall units if they did add 8 locations. They've just begun to expand internationally, and their approach there is to license rather than operate restaurants or have subsidiaries that operate restaurants in other countries. And so far they're in the Middle East and in China with 11 restaurants as the end of last year, and they expect to have 15 or 16 by the end of this year. Licensing revenue is very good because it's almost all profit, but it's not going to contribute substantially because we still are at a low number of these licensed restaurants. The company, as we saw on the 10-year history, is definitely sensitive to recession. So we will see earnings drop off during a recession. Some restaurants are a little more recession-proof than others, but again, the Cheesecake Factory has a little bit of higher profile. I think it's perceived as a little more costly, which is great during good economic times. But if you're watching your pocketbook and you are coping with being laid off or the threat of being laid off from your job, the Cheesecake Factory is probably not going to be quite as high on your list as some other options. Now, interestingly, a couple of months ago in the small cap informer, we started focusing on BJ's restaurants. And when you look at BJ's, They are a brew pub or brewery/restaurant chain. They are a little less mature than Cheesecake Factory, but they've been expanding a little more rapidly. But the thing is, when you start looking at the metrics of the restaurant industry and how the various chains stack up, the BJ's has one of the highest checks, if not the highest average check per, well, I'm not sorry, not the highest average check per square foot. They have a floor plan that allows them to seat more people at once, but the average check is only about $15 or $16 compared to Cheesecake Factory's $21, but each BJ's location is a little more profitable than Cheesecake Factory's. Cheesecake Factory's is a little more spread out in the seating and the total square foot of the entire restaurant. But when you start looking, and again, the BJ's restaurant website has some interesting investor presentation where they show you how BJ's stacks up against the Cheesecake Factory and about a dozen other casual dining establishments. So I think it makes a really interesting comparison to look at the Cheesecake Factory and BJ's Restaurant, ticker BJRI, BJ's Restaurants Incorporated. I think that'd be a real interesting comparison for you to make. Two well-run restaurant chains. They have slightly different focuses. Neither of these are going to be, the super fast growers that some you might be looking for in your portfolio. But I think it's a nice way to kind of round out, and certainly it's a great way to do research on your portfolio if you're so inclined to have some of these top-notch casual dining establishments in your portfolio. So that's the Cheesecake Factory. Al, just to confirm, it's BJ's, and it is public, ticker BJRI is the ticker symbol there if you're going to compare those companies. So if you have any stock ideas, please feel free to share them now. Just point out I've got a couple of events coming up around the country. October 5th, I'll be presenting a webinar for the Better Investing Stock Up webinar series on managing your investments using PERT and portfolio management. You'll find more about that on the Better Investing website. Later in October, the 20th and the 21st, I'll be at the Money Show in Dallas, Texas. This is the first time the Money Show is going to Dallas, so this is a new location for them. So I'll be there to present and be there with the iClub Better Investing booth in the exhibit hall. Admission is free, so please go ahead and check it out. The November 12th, I'll be in Seattle, Bellevue for the Puget Sound Better Investing Chapter's annual Investor Education Conference. This year it's a one-day event on Saturday, November 12th. I've got 4 great classes on stock analysis and stock screening and growth stocks and small caps that I've lined up to present at that class, and I'll also be there with a table with all sorts of special offers for attendees. And then on December 5th, I will be at the Better Investing Philadelphia chapter for the annual Doug Gerlach Day, where we'll take a look at club tax preparation, year-end, closing the books at year-end for clubs, and also our investment club portfolio review, where we'll take a look at actual club portfolios that are submitted and look at the diversification, look at the allocation of incomes, industries, and sectors. And we'll look at the growth rate of the selected companies, and again try to give some direction for clubs to improve their portfolios over time. So that's December 5th, 2016 at the Philadelphia chapter. So a couple of ideas that people are asking about Buffalo Wild Wings. I'm not a fan of Buffalo Wild Wings. In fact, I find that I believe the company is a little overextended and that the growth rate is going to be really declining as they are, as they've really, built out just about as much as they can go, and I think it's sort of a trend. But you can see that in the earnings flattening out really in 2015, moderate increases, 13% increase in the second quarter. Toolkit doesn't like it at all because of the flatness of last year's results. Analysts looking at 19%. I think that's really, really aggressive. Even if you peg it down to 15%, I mean that's possible, but that assumes that that there are markets that Buffalo Wild Wings has not penetrated yet. I'm just not sure that that there are a lot of places that are left that are underserved by Buffalo Wild Wings. You can see the PE ratio is pretty high at 30 right now. It's down a little bit from a high of 38 earlier in the year. But as that growth rate starts to decline, I really think that's pretty excessive. I mean, I think that the 5-year potential, if you look at where the company has been, let's see, Toolkit likes this, the default judgment likes 106. I think that's pretty low. I'll go with 122. So that just puts it in the hold range with a pretty low compound annual return. I just don't like their business model. I think it's built on, it's kind of locked into a particular food trend. And I don't think that wings is going to be something that's going to continue to become popular over the next decade or 5 years at the same level. They've kind of pioneered this, and so there are a lot of reasons I'm not a big fan of Buffalo Wild Wings. I would much rather go with something a little more upscale, a little more unique, and I think Cheesecake Factory and BJ's might fit into that definition a little bit more. Texas Roadhouse. Texas Roadhouse is really an interesting, let's see if I can remember the ticker symbol. It's a company that, it is Texas Roadhouse, is that right? Yes. Is a company that I've used for educational purposes because look at this SSG graph. I mean, this is up straight in parallel. Look at this company in 2008 and 2009. What happened to there? We saw Cheesecake Factory, you saw the decline. Here, the company just had a flattening of earnings in 2008 and then immediately recovered in 2009. I just think it's a really strong company. They have, again, earnings per share have been really popular, are really strong. Sales growth is really strong. Margins have been coming down though, and I don't like that quite so much. I think that's a little problematic. You know, food costs, food inflation has been running rampant, so you really have to manage expenses pretty well. But I wouldn't argue with. I like this as a company much better, and I feel like that. What is their revenues? Yeah, 1.8. Compare that to Cheesecake Factory 2.1. I mean, they're very similar in size. So yeah, I think that's one of the restaurant chains that I like from an operations perspective. I'm a little concerned about the margins, but I like the growth, and I'm kind of surprised we don't see it more frequently because of this significant growth trend the company's got going on. And this is with, you know, looking at earnings growth of 11%, which is pretty conservative. And that's just a, you know, back of the envelope kind of figure there. But you know, you could definitely add that into the mix, and I think that would be pretty interesting. Let's see here. Al asks if I'll be doing anything with the stock comparison of Toolkit 6 that I did recently. I guess with our Toolkit 6 webinar, we did the comparison, and I don't have anything about the comparison on my agenda for that event. I'm not sure. The program, I think it's mostly finalized, so maybe the chapter, the Puget Sound chapter is on their cruise to Alaska, or maybe they're just getting back. So I don't know if that if the agenda has been published. Usually they cover the better investing tools pretty thoroughly in one form or another. I'm not sure if they've got anything on the comparison guide on this one. Al says, I'd like to be able to save the comparison feature. Well, let's open up a comparison, and we'll sort by industry, and we'll look at some restaurants here. We'll put Texas Roadhouse, we'll put BJ's, and we'll put Cheesecake Factory, and we'll put Buffalo Wild Wings on there, and we'll compare them. You can print this. So the trick is to install a PDF printer. Like this is mine. I have the one called PDF Factory installed, and I have another one called Do PDF installed. When you do that, and these are free programs, so search for Do PDF or Qt PDF. When you do that, you can print from Toolkit, and you can save it as a PDF, and then you can export it. So we'll go ahead and click OK, and then here it is. Here's the PDF file. So I can save that, send it off. It's already saved on my computer. I can save that and send it off. I have in the Toolkit webinars on sharing and emailing stock studies, I have a section there on using a separate PDF creator program that you download from the internet, you install on your computer. It operates as a printer and allows you to save any internet web page, any file from Toolkit or any other program as a PDF that you can share around. So that would be the best way to do that. What do you think of Kroger's? I don't follow Kroger's. Although, you know, it was one of the grocery stores that my grandmother used to shop at in the, in the farm in Ohio. We're not going to see a whole lot of growth out of Kroger's, but and so I don't know. I don't have a good sense of how the company has been expanding. I know there's a lot of consolidation going on in the grocery industry. It's a very big company, so $109 billion in sales, that's way too high. Let's say 6% sales growth, 8% earnings growth. What does that get us for this company? And imagine that 7% is the minimum growth we'd want to see. Let me add another scale there so we can kind of see how things go. The margins are always going to be very low. I see a little trending up. That's kind of good to see. 3% is a pretty good margin. So here we are in the 2.8 range last year. That's not too bad. You can see why a lot of people are not. I'll take out that year so we can look at that graph again. Yeah, their margins have been pretty stable in the 2 to 3% range, mostly around 2.5%, and that's a pretty good sign. The grocery store industry's been shifting a little bit in the last 2-3 decades, where first stores were getting bigger with the mega stores. They were competing with the superstore concept, so they were all retooling. Then we see the smaller specialty stores like Whole Foods, like the Fresh Market, like Sprouts, which take it down a notch and make it into a smaller operation with less inventory to worry about, less product selection, higher quality product selection, focus on organic and natural foods, which a lot of consumers respond to. So it's been definitely an interesting business, and might be a good staple for a portfolio. What I'm looking at right now, let me just again, just back of the envelope kind of calculation, a stock selection guide. I wouldn't exclude it, and it's very close to being a buy. It's a low total return option right now, 12%, 2.6 to 1 upside downside. So that's pretty close. If the price got down a little bit lower, I'd be a little more excited about it. It's at a near 52-week low, so I'd want to understand that what the future holds for Kroger a little bit more. But based on the history of management, it's certainly not a company that I would eliminate out of hand. Oh, Dick points out that Windows 10, if you're running Windows 10, it has Microsoft's print to PDF feature, which, I had forgotten about that because I rarely use it. So when you print, there's an option to select PDF printer, and so you can use that if you're using Windows 10. Was that in Windows 8 as well? Not sure. Can't remember. Did I skip over Windows 8? Maybe I did. But it's definitely there in Windows 10. Thanks, Dick. That's a great point. Stella Jones. Bruce asks about Stella Jones. sj.to. See if that if we can download that. So this is a Canadian company. It's a basic materials company. You can see the $1.5 billion Canadian dollars is the size of the company. You can see pretty good growth. You can see a little bit of a downturn, post-recession. Don't know when their fiscal year ends. It's the end of the year. So post American recession, a downturn. So everything here is in Canadian dollars. So just bear that in mind. I tend to avoid Canadian stocks. I like the margins. That's pretty good. I would like to compare them, of course. A little bit of debt, but not, which may be okay based on the basic materials industry, how they need capital. PE ratios have been expanding. You see that right now. They're at 18, a PE of 18. It's been as high as 23 and as low as 16.6 in the last 52 weeks. So, on a back of the envelope kind of basis, it doesn't. There's nothing that's jumping out at me. I want to know if those margin trends, the margins are fairly stable. I want to know how they compare. I want to know again, the whole Canadian dollar thing makes it a little tricky while you can certainly invest in it. You have to, dividends are going to be reported in Canadian dollars as opposed to American dollars. So you're going to have to make sure you enter proper amounts, et cetera, et cetera. So I wouldn't eliminate it. I know it shows up on the roster of quality, I think, on a fairly consistent basis. And again, we don't eliminate those Canadian companies. I have some. If I had my way about it, I might exclude them altogether because they do cause a lot of confusion. But there are a lot of companies that there are a lot of investors, toolkit users, and clubs in Canada, and so they're like looking expressly for those Canadian companies. But that might be something that, and that's why they're included. But often I'm not. And we cover a couple of them in the small cap informer as well, but just generally I'm not as enamored of investing in Canadian companies. Again, if they're ADRs, that's something a little bit different. That's a slightly different formula there. Bruce asked, last stock here, Bruce asked about GameStop, ticker GME. Yeah, this is an interesting business because he points out the company has been diversifying, and this is why the company's been diversifying. GameStop sells video games, consoles, units, and the problem with this business is that much of the delivery of video games has become electronic. So you buy a game and you download it. You don't buy a game and get it on a DVD anymore, or on a that you install or that you run. Consoles are increasingly becoming most games now, if they don't require a connection to the internet, offer some sort of feature that if they are connected to the internet, you get certain advantages and gameplay options. So this is the problem. You can see their sales have been flat for half a decade. Wow, really, crikey, that's 7 or 8 years. Revenues have been down or trending sideways. Earnings, they've been able to kind of creep up earnings a little bit. Gosh, analysts looking at 15%, which I think is pretty aggressive, and might include a positive outlook for the types of diversification efforts that Bruce is mentioning. For me, I don't know, 10 or 12% would be my starting point. And you can see that kind of fits with what's been happening since 2011 when things took a little bit of an upturn. During the recession, again, a little bit of a downturn, maybe because their customers, you would expect, are at the low end of, young men primarily, and they're at the low end of the economic spectrum in terms of full employment, part-time employment, or and during recessions, maybe that some of those part-time positions dry up and they lose the segment loses buying power. That could have an impact on a company like GameStop for sure. You can see margins have been pretty consistent. Again, that's pretty good. Might be hard to find some direct comps for GameStop. Yeah, you can see the PE just really trending down on the high side, and I think that 19 is probably pretty high. So let's say we use 12.6 and 7. You can see the low price 20. Current prices, see the current price is 27 and the forecast low price is 29 because the current PE is lower than, and even, gosh, that low PE is just lower and lower as there's a lot of investor uncertainty. Let's say 6.5%, which is the 52-week low PE, takes the price down to 24. So, again, this is a company that there's a lot of downside. It's really close to the downside, which puts it a little more into value territory. So from here, I would be inclined to disqualify the company from consideration just on the basis of sales trends right now. And my preference for companies that are not just expanding their margins or profitability, but expanding sales as well. They're selling stuff that's essential. And I think the longer term trends probably working against GameStop from the perspective of a growth investor there. Yeah, Al says hard to accept earnings so much higher than revenue. Yeah, when you look at the pre-tax profit there, you don't. Al has a really great point. And if you look here at the pre-tax profit that's tracking sales, and you look at earnings, which has been going up, how does this happen? Well, there's only one way that it happens, and that's because the number of shares has been consistently going down. You see that the O there. I'm going to spread these out a little bit so we can see each component just a little bit better. So here's, crikey. There's sales, pre-tax profit, earnings per share, and this is shares outstanding. And you can look at how since 2009, the company had, let's see if we can pop up a little display. The company had so many more shares outstanding. They've been using cash and buying back shares, and that's why earnings are going up. So that's a really interesting something you don't see very often. Shares outstanding declining so much. When shares outstanding go down, the earnings per share go up, assuming even if the earnings are flat. In this case, the profits have been flat for 7 or 8 years, and the company is manufacturing earnings per share increases by buying back shares outstanding. So I think that's the key here. Number of shares going down. We'll pop it up. Let me just pop up the data, and we'll look at the annual data just to see over here. On the right, the number of shares outstanding have declined from 160, almost 167 million shares outstanding in 2009 to 106 million shares outstanding at the end of last year, and 104 million shares as of the end of the second quarter. So 167 million to 104 million shares outstanding. This is what they're doing with their cash. Again, just doesn't fit the growth profile that I like to see from companies. All right. Thank you all so much. It is exactly 2:30, so we'll wrap it up for our September Lunchtime Stock Club. We'll look forward to seeing you at our October meeting, which will be coming off on the second Monday of October, as well as our other Toolkit and Investment Club webinars later this month and those special events that I pointed out. Thanks again. I hope your third quarter performance in your portfolio continues to do well, and we'll see you next time.